So next graph, the inflation adjusted
All-time
gold.
high.
Yeah, gold. So tell us about this at 2,400 bucks.
Well, Mike, I mean, many people keep telling us, well, gold, trading at 1800, it's already too expensive. I said, no, it's not. I mean, um, if we compare um, the current price to the inflation adjusted all-time highs, actually gold would have to rise to 2,400 US dollars. Now, this is only the official CPI calculation, and I think you're also a bit um, critical when it comes to the calculation of the CPI, and many people call it the CP lie, actually. So,
Hang on a second. I am the one that first used that term in
okay.
my book. I wrote that back in about 2006. And so I called it the CP lie in my book. And so everybody has latched onto that because it is. They're only counting specific items. And when I measure inflation in my book, there was a chapter where that got cut out of it. But I came up with my own measurement of inflation based on the fact that every dollar created must go somewhere. And so I called it CUP inflation, CUPP, and it stands for currency units per person.
Mhm.
And that to me is the ultimate measure of inflation. What we are seeing right now is inflation of consumer prices at the grocery store and the gas station, but we're seeing a huge deflation currently in asset markets. Real estate is rolling over and the stock market is down significantly. So, yeah, keep on going with what you're saying. I'm sorry that I.
No,
Uh,
no, 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 no worries at all. But I think it's just telling us, well, actually, gold inflation adjusted is not expensive at all. And normally, over the course of a big bull market, you take out the inflation adjusted all-time high. So basically, 2,400 US dollars would be the next stop, the next target in this bull market. And and I think what's really important is if we compare, many other key figures at gold's all-time highs in 1980 and in 2011, and if we compare it to the current setup, well, for example, the monetary base in 1980, it was 157 billion. Now at the moment it's 6.2 trillion. But actually, gold compared to 1980 is only, up 1,000 US dollars. So back then it was 850, 870, now it's 1,800. If we compare the M3 money supply, it is up actually, I think, 8 or 9 times compared to 1980. Or
mhm.
if you compare, um, I don't know, GDP per capita. In 1980, it was 12,000 US dollars. At the moment, it's 73,000. Federal debt, 860 billion. Now it's more than 30 trillion. Um, a median house price in 1980 was 63,000. Now it's 428,000.
By the way, you're using monthly gold data in this chart. So you've got gold peaking at about 600 and something dollars
Yeah.
when you're in inflation adjusting it. If you use the all-time high of 873 in January of 1980, it comes out just a whisker under $3,279. So
Yeah.
basically $3,280 is the inflation adjusted if it was in balance with inflation. If gold was in the same balance it was back then. But yeah, the silver prices you come up with, if you take that 1980 high, I went through all of these different aggregates of the currency supply and stuff. You can't show silver in double digits. Everything comes out in triple digits, and some of the triple digits, some of them come out in quadruple digits and $1,500 an ounce and even higher. I think there was one measurement where if it was in balance with, I can't remember if it was a portion of the currency supply, it was showing like $3,000 silver. And it's not because silver is going to go to those prices. It's because that portion of the currency supply, like base currency, has just exploded. And it's the Federal Reserve has gone crazy. All of the world's central banks have gone crazy.
So, I mean, I think it's pretty clear. I think we should always compare current prices on an inflation-adjusted basis, and then also to the development of other asset classes, of other prices. And I think then it's really crystal clear. Gold is still dirt cheap, silver even more so. And the fact that so many people, this is retail investors, but especially high net worth individuals, institutional investors, they keep telling me, well, now it's already way too expensive. For me, that's a pretty nice confirmation that actually we're miles away or light years away from the end of this bull market.
Yeah, when those same people are telling you now is the time to buy gold, now is the time to buy silver, because they will in the future at far, far higher prices than this. So next one, the interim target by the end of 2022. I think we covered this in an earlier video.
Yeah.
But I want to know about that 2030 estimation and how you came up with that. I think your interim target is a good one. I just see going far, far higher than $4,800 in 2030. And I really think that, the big move comes right at the end. Gold spent about 8.25 years or a little more getting from 35 to 400, and then it got to 800 in just a month or so. So there's a really big blow off top that comes with almost a vertical move at the end. And personally, I expect it to be way before 2030. So tell me about this chart and how you've got 2187 by the end of this year.
Well, this is actually the target that is based on our gold price model, the long-term gold price model that we explained in our 2020 In Gold We Trust report. That was talking about a golden decade. Now, Mike, I worked in a bank for quite a while, and I know that there were so many really smart people, quants and rocket scientists, whatever, that kind of wasted their mental capabilities by not working in science, but rather preparing models for banks, risk models and so on. And those models were so complex, they were so sophisticated, but the problem was that actually they didn't really work in practice. Especially, we saw that in 2008, 2009, as this black swan came along. Now, we really tried to keep it simple with this gold price model, and we explain everything in the 2020 report. Now, actually, we had a look at the price of gold and what actually explains the price of gold best. And we say that actually gold cannot be calculated, or a valuation of gold cannot be done like with cash flow generating assets like bonds or equities. So you have to come up with different measures, and we use the money supply developments and the so-called implicit gold coverage ratio. So we have different scenarios for how the US money supply might develop. And we take, for example, we take basically three different things. We take an M2 growth rate like in the 1970s, which was 9.7% per annum, and we give it a probability of 15%. Then we've got an M2 growth rate like in the 1990s, that was the lowest growth rate. It was 3.9% monetary growth per year, and we give a probability of 5%. And then, we are conservative. We say, well, let's have a look at the average growth rate of M2 since the 2000s, which was 6.3%. And based on that, we forecast the future development of the money supply. And then we take a second very, very important figure, which is the implicit gold coverage ratio. So that's basically, it is calculated by valuing the central bank's gold reserves at the current gold price and then relating them to the money supply. So for the US, for example, the gold coverage ratio at the moment is somewhere, I think, for M2 around 3%, heading lower. And then we say, well, everything is about trust. At some point, there will probably be a crisis of trust, of confidence, and we will need higher gold coverage ratios. So then, we have got a smooth probability function, and then we come up with this scenario tree, with this distribution probability. And actually, as the chart says, our expectation for the gold price at the end of this decade, so by 2030, is $4,000, 4,800 US dollars. But actually, the interesting thing, Mike, is that the distribution is clearly skewed to the right. So actually, significantly higher prices are far more likely than lower ones. Now, of course, we know we have to take those models with a grain of salt. I think it makes sense how we structured it, and as I've said, you can read it in the 2020 report. And now, in this chart, we show, well, actually, how is it progressing based on this long-term model. And actually, if the model should be right, then we would have to reach 2,187 US dollars by the end of this year. And now this might sound a bit too high, too bullish, but actually I think it is still quite realistic, because that at some point monetary policy will have to move away from this hawkish path. At some point, they will have to return the punch bowl to the market. They will have to show that actually Wall Street is probably more important than Main Street. And I think that, we've got midterm elections coming up, and I don't think that Joe Biden really wants the S&P down that much. I think he doesn't want to see so much suffering from voters having a look at their portfolios. So I think they will at some point orchestrate this monetary U-turn, and then I think this 2,187 US dollars is quite realistic.
Yes, I agree. It's going to be somewhere near there, but I think there's quite a range. But that's a very good target to come up with. In this environment, though, it could be far higher. If there's a short-term crash that happens near the end of the year, it's going to be lower. But I'm expecting that crash to happen quite a bit before that. We're only halfway through the year here, so we've still got 6 months to go. And in a crash, what we see is, because of margin call and things like that, you've seen it. Gold and silver do a pullback, but then they take off like a rocket right after that. So What I do is I dollar cost average in, and then if I see a pullback, I mean, during the COVID crash, I wish I had known more about how to buy and sell oil contracts, because oil futures, there was a period there where
Well, negative.
people were paying
Yeah.
you to take their oil because they were worried that somebody might put it to you, and you actually had to come up with a place to store it, and there
Yeah.
was no place to store it. So, yeah. Anyway, it has been fun having you on again. I always enjoy going through these very, very well-researched charts every time you come out with one of your In Gold We Trust reports. So tell us about your company and tell us where people can find you.
Yeah, well, I'm managing partner at Incrementum AG based in Liechtenstein. We are asset managers. We manage 6 investment funds, and we do wealth management for high net worth individuals. And then we also publish the In Gold We Trust report, which is probably now one of the most widely followed publications on gold. It's published in German, in English, in Mandarin, and now also in Spanish in the compact version. And you can download it totally for free. You don't have to register. Just have a look at our webpage, ingoldwetrust.report. You can download this edition in the big version, which is roughly 400 pages. So it's quite a read for your vacation or for a long weekend. But there's also a compact version. And you can also download all previous versions of the report for the last 16 years. And yeah, besides that, I'm pretty active on Twitter. My handle is at Ron Stoeferle, and that's basically it. And I thank you very, very much for the invitation, Mike. It's always a great pleasure, and wish you a great summer, and look forward to talking to you soon again.
Okay. It's been great. A lot of fun. Thank you very much.
Thank you, Mike.
Great.
All the best. Take care. Bye-bye.
At goldsilver.com, we have a price match guarantee, free shipping, and global storage options. Get the best-selling book, Guide to Investing in Gold and Silver, for free at goldsilver.com.